Hello, and welcome to Virtual Investor Conferences. My name is John Viglotti on behalf of OTC Markets, as well as our co-host, Skyline Corporate Communications Group. We're very pleased you joined us for our Small Cap Growth Conference. We'll kick off today with a keynote presentation titled Small Cap Investing in a Recession, How Companies Rise Above the Fray. And before I introduce our speaker, a few points to note. Please submit your questions in the question box to the left of the slides. And if you're interested in scheduling a meeting with Skyline, please click on the Meetings tab found on the left navigation bar. You'll be able to view the company's availability and submit a meeting request. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome our keynote presenter. He's Scott Powell, President of Skyline Corporate Communications Group. Welcome back, Scott.
Thank you, John, and good morning, everyone. Welcome to the virtualinvestorconferences.com and the OTC Markets Group Small Cap Growth Virtual Investor Conference. As John mentioned, I'm Scott Powell, President of Skyline Corporate Communications Group, LLC, which is an investor relations agency providing corporate communications and investor relations services to small and micro-cap public companies with locations in New York City and Boston. We're pleased to be the co-sponsor of today's virtual investor conference, and we'd like to thank the OTC Markets Group, virtualinvestorconferences.com, and John Viglotti for today's opportunity to deliver the keynote presentation titled Small Cap Investing in a Recession, How Companies Rise Above the Fray. My presentation today aims to discuss a pertinent issue facing investors and management teams in these volatile market conditions. How does a small cap company rise above the fray in negative markets? Turning to slide 2, economists can debate whether we are technically already in a recession, but it's fair to say that the markets have been very weak in 2022. At the 4th of July holiday point, with just over half the year completed, the Dow Jones Industrial Average is down roughly 15%, the NASDAQ Composite is down 30%, and the Russell 2000 Index is down 25%. In fact, the OTCQX Composite is down 23%, and the OTCQB Venture Index is down 37% for the year. Whether you believe we are in a recession or not is a moot point, since the market appears to have priced in lower growth for growth-oriented companies. The Fed seems committed to increasing interest rates, which may drive the economy into a recession to effectively combat rising inflation. Couple this with geopolitical events such as the war in the Ukraine, COVID lockdowns in China, and stalled global supply chains, and it's fair to say that investor sentiment is quite negative at a macro level. We see this persist in our capital markets, where raising capital has become more difficult and more expensive for companies. By more expensive, I'm referring to the greater demands from institutional funds and financiers during a deal roadshow, which is typically in the form of greater discounts and structured deals, because investors demand greater returns when assuming greater risks in a volatile market, something most everyone joining this conference today is looking for. After all, that's why small caps have a unique following, because of the perceived higher risks but greater rewards. The lifeblood of small cap companies are healthy capital markets because of their needs to fund current and future growth. So when markets turn negative, as they already have, how does a small or a micro-cap company continue to grow and rise above the doom and gloom in the markets? Turning to slide 3, the instinct of many companies is to go quiet because they assume that nobody is paying attention to them with the markets in flux. I hear many clients tell me, why don't we sit back, And wait this out. Investors are glued to their screens, not attending conferences, not participating in roadshows and corporate presentations. Retail investors are pulling their money out of the market. There's seemingly no confidence that individual companies can make impactful strides in such a market. However, this is exactly the opposite approach companies should take during these times. Now, I understand that many companies are legitimately worried, perhaps looking at their cash balances and understanding that a financing may not be in the cards for some time due to the market conditions. With stock values down across the board, raising money in this market at depressed values will not win over your existing investors. However, small cap executives need to remember why they have a shareholder base today, because they have a compelling business with an investment thesis that has attracted investors. Turning to slide 4, executives need to continue educating and informing investors, keeping them apprised of the near-term challenges and the potential opportunities or silver linings in the marketplace. I've said this in past addresses and to our clients on many occasions, but investors are betting on the jockey, not the horse, particularly in small and micro-cap public companies. I mean that a company can possess the best technology and have great assets, but management's credibility is more likely than not the deciding factor for an investor investing and then sticking with that investment. After all, if a small cap company is ever going to become a large cap company, an investor assumes that the business can persist despite recessions, market corrections, and other marketplace volatility. Turning to slide 5. The first priority, since nearly everyone uses a search engine to research a company, is that small cap companies need to conduct an audit of their online presence, including the corporate website, leading financial portals, and anywhere else that an investor would look for up-to-date information on your company. The company's website needs to be the end destination where investors stay and further explore the company. A strong website can typically pass the cocktail party test, where an unfamiliar viewer can clearly understand and describe the company and its core business in a matter of minutes. A stale, outdated website will undoubtedly lead the viewer to believe that the company is idle or simply not paying attention, as if the windows at Macy's were filled with toppled mannequins covered in spiderwebs. Perhaps more important, visiting Yahoo Finance or Bloomberg or one of the brokerage websites is noticing that the company is mislabeled, for instance, as a biotech company when they sell auto parts. At the same time, companies should actively facilitate more research on the company with greater transparency. Add the most recent company investor presentation and recent conference call transcripts. Go the extra mile. Post a calendar of events that includes industry events along with investor events, conferences, roadshows, and so forth. These initiatives go a long way in demonstrating that activity is continuing despite these turbulent times, and the company is moving forward despite the market volatility. One final note on the website, which is usually the most overlooked part, is the means of gathering information on visitors to your website. I don't mean using cookies to track visitors. I'm referring to the Contact Us page or tab, and more importantly, the invitation to join the company's distribution list. Too often, these are buried on the website. These should be accessible at the top and bottom of every page, making it easier for a visitor to subscribe to the company's updates, press releases, and so forth, collecting the visitor's name, company affiliation, phone number, and email address, as part of the registration process. Turning to slide 6, a proactive communications program should be developed that encompasses public statements such as press releases, shareholder letters, shareholder videos, media outreach, and social media. In these communications, it's important to have greater transparency with the public on the company's challenges instead of sugarcoating the current situation. This approach will boost management's credibility with investors as long as there's a plan from now on that strengthens the company. Shareholder letters are still very strong communication vehicles to update investors, typically written by the CEO or the chairperson, without needing a strong catalyst or material event. So, for instance, at the year-end, fiscal or calendar year-end. But these should be used sparingly, at most twice per year, to preserve their importance. Many companies now are producing shareholder videos instead of the traditional shareholder letter in order to reach younger viewers who prefer video, while expanding their messaging to include additional company voices and product demos through these videos. This is fine as long as a transcript accompanies the video. Media outreach is another important tool. From the media outlet's perspective, they are trying to generate attention, just like companies are trying to. And these media outlets are looking for compelling stories amid a market downturn. As I mentioned earlier, many companies opt to go quiet in these times, so there's naturally going to be less competition in pitching a story to a reporter or an editor. Companies should pursue outreach in their industry's leading publications and in the financial media at large. The potential long-term benefits can be significant, especially when developing media relationships. These relationships can be valuable, particularly if the company becomes an industry resource that would expand its exposure in future articles and stories. In most instances, the publication will allow the company to disseminate the article or mention it to their shareholder register or post it on the investor relations page of the company's corporate website. Concerning social media, I presented on this topic at the OTC Virtual Investor Conference back in February of this year, where I went into great detail about which platforms companies should use and the best practices for them. I have been a proponent of social media as an investor relations communications platform. The various social media platforms accessible in the marketplace, albeit with their respective strengths and weaknesses, facilitate companies in reaching and connecting with retail investors in an efficient and relatively cost-effective manner. Social media channels provide companies with a cost-effective opportunity to target and reach users with similar interests. Providing context and establishing the company's voice offers the ability to stand out from all the other noise on social media, which shouldn't be looked at as simply a forum for posting press releases and financial metrics. It's about providing context around all areas of the business to enable investors to gather comprehensive, credible information to piece together a complete picture of the company. Successfully leveraging these social media channels adopted by investor audiences allows companies to develop a consistent voice that engages when appropriate to answer questions, clarify misinformation, and stave off potential crises. Importantly, companies can use these powerful tools to disseminate thought leadership that can strengthen a company's credibility within an industry or enhance the brand's positioning. Since these communications fall within the purview of investor relations, it's important to maintain transparency so these messages on social media align with what comes from the investor relations department. Turning to slide 7, an important part of the communication strategy is connecting directly with investors. Forums like today's event are an excellent platform for engaging with investors and communicating the company's story to a captive audience, despite the market noise. Conferences are fantastic ways for investors to ask questions of the management teams of companies they are considering investing in, to have their concerns addressed directly, and for investors to provide critical and actionable feedback to C-level executives of these public companies. I've had a great deal of travel recently to conferences and events, and there are pros and cons to the in-person versus the virtual conference settings. Both settings have successfully gathered investor attendees. In times like these, the more cost-conscious company can look to virtual conferences as a cost-effective alternative to paying for flights, lodging, transportation, and meals, while being able to present to investors and not losing valuable time from the office. On slide 8, investor relations agencies like Skyline and investment banks are arranging virtual webinar presentations for company executives to present to groups of investors that they may not ordinarily meet during traditional non-deal roadshows. For example, my firm Skyline Corporate Communications Group, LLC, regularly holds our proprietary branded live webinar events, the Skyline Signature Series. This event provides public companies with a convenient and effective forum to communicate their story to a diverse audience of financial professionals through live CEO virtual presentations. The Skyline Signature Series is intended to generate additional exposure across a wider North American audience for public companies with compelling stories by harnessing video technology. Our financial community participants are carefully curated and qualified by Skyline. We offer the ability to participate in the Skyline Signature Series to our full-service investor relations clients and as a standalone service to qualified public companies that have been approved to present by Skyline. We believe that virtual presentations, just like today's event, are an excellent way for companies to access institutional and retail investors because it removes geographic restrictions. Compared with a one-on-one meeting, this format is very appealing for investors who are not familiar with a specific company's story. It's more likely that they will take a chance and dial in for a group virtual webinar presentation where there is less pressure and obligation to research a company in advance and read its public filings, which they would feel more obligated to do if it were a one-on-one meeting between the investor and the management team. And the investor would be more likely to pass on such a one-on-one meeting. In closing, on slide 9, whether it's a recession or a general market downturn, people know that small and microcap companies are often affected far greater than their larger brethren. Companies are apt to go radio silent, preferring to wait this out for better times. But most investors know that these times don't last forever and sometimes lead to greater opportunities, a chance to invest in a company at a lower share price or discount. Small cap companies will want to be on investors' minds when market conditions improve and greater investment capital is being deployed into the public marketplace. Take this time now to educate and inform the investing public about your company and plant the seeds for the future harvest. Once again, I'm Scott Powell, President of Skyline Corporate Communications Group, LLC. Skyline is an investor relations agency located in New York City and Boston. We're dedicated to providing investor relations and corporate communications services to small and microcap public companies across industries and geographies. We are a senior level team with a combined experience of over 75 years in the capital markets, finance, law, direct investments, and public company management experience. Our team has worked with hundreds of small and microcap public companies across industries, and we are a highly capable, responsive, and effective group of experts in investor relations and corporate communications for smaller public companies. We encourage you to visit our website at www.skylineccg.com and to visit our LinkedIn, Twitter, and StockTwits pages, or email us or call us at the address and number on this slide. Thank you again for your time and attention today. Thanks to the OTC Markets Group and the virtualinvestorconferences.com for the opportunity to sponsor and speak at today's conference. I would now like to turn the call over to Skyline Corporate Communications Group's Vice President, Lisa Gray, who will moderate the question and answer session. And as a reminder, if anyone has any questions, feel free to pop it into the Q&A box on your screen, and Lisa will read the questions to me. Thank you again. Lisa?
Thank you, Scott. The first question, does a company's messaging change when there are big changes in macroeconomic indicators?
That's a really good question. Does the company's messaging change? I would say at a high level, no, that the messaging should remain consistent. This company's story, the growth prospects, the company's, whether it's a disruptive technology or unique product, I think the messaging should largely stay the same. I think the issue is that companies tend to communicate less in difficult market environments. There's a tendency, it's just human nature. There's a tendency when your stock is down 10, 20, 30, 40%, as many public company stocks are down currently, you tend to have, obviously, shareholders that are not very happy, right? They tend to blame the company and instead of looking at the macro environment. And companies, when their stock is not performing well, they don't feel as proud to go out to conferences to meet with investors, right? Because the stock is down. And that often, incorrectly, often signals that something negative has happened with the company's operations. And that's often not true. We've just had a very difficult macro environment over most of 2022. Right? We have significant inflationary concerns. We have supply chain disruptions. We have energy prices soaring. We have a political situation in Russia and the Ukraine, and all of these issues have worried investors and have sent the U.S. stock markets down substantially. So I think rather than changing the company message, I think keeping it consistent is the right approach, but not pulling back from communicating. Right? I published an article a number of years back, and it was focused on the importance of communicating during difficult times. Companies, it's just human nature. People don't like to communicate with investors when investors are not happy, right? When your stock price is down 20 or 30%, there's a tendency not to want to communicate. And I think that's the wrong approach. I think the level of engagement should remain roughly the same. I mean, unless there are significant cash flow concerns, if a company had expected to go public or uplist or do a secondary offering, and there are significant capital constraints, in a situation like that, it's understandable that the company may pull back a little bit on travel expenses and investor relations activities. But as long as the budget is there, I think it's important to maintain the same messaging and maintain the same level of investor engagement. Because it's actually more important to communicate with investors in difficult times than in good times. In good times, when your stock is up 10, 20, 30, 40, 50, 100%, investors are generally very happy, right? It's easy to talk to investors. and that's, that makes investor relations easy. It's when your stock is down, the market is challenging. Investors are not as happy, obviously, because their investment is at a loss for the most part. It's actually those periods of time where the investors need reassurance that the company's strategy, the company's products, the company's competitive advantages haven't changed. Just the market conditions are tough. But again, a very good question.
The next question is from an investor perspective. Do small cap companies provide revenue guidance? If not revenue guidance, are there other projected metrics an investor can ask for?
Another good question. I don't know the exact percentage, but many, if not most, small and micro cap companies don't provide guidance. And there's a couple of reasons for that. One, many, especially many OTC companies are pre-revenue. They may be technology or biotech companies that are developing innovative drugs, innovative technologies and products. And so a lot of companies are pre-revenue. And so they can't really give guidance, right? Unless they're going into revenue generation mode in the next year or 2 years, it's hard for them to give any revenue guidance. The second thing is the predictability of revenue stream. So if you're transitioning from, let's say you're a diagnostics company, you're transitioning from clinical stage to commercial stage, it's very, very difficult for many of these companies to give accurate guidance. And so the guidance they give will often be wrong, right? And so, if you're really conservative with the guidance and you beat, revenue estimates, that's generally a good thing, right? But oftentimes you're giving, expected numbers and you miss them, and that can be very damaging to the stock price and also to the management team's credibility. So for these two reasons, one, that just a lot of small microcap companies are pre-revenue, and two, a lot of companies in this space, where the market caps are 20, 50, 100, 200 million, oftentimes they're growing very rapidly, and it's very difficult for them to project accurately future revenue figures. And so a lot of companies just simply don't give those metrics for these two reasons. They don't know, they want to preserve, credibility, and they don't want to miss their figures. And it's very difficult as these companies ramp. I think one way to deal with that situation is talk about the total addressable market, and be reasonable and conservative with these numbers. So, if you're in animal health, for instance, and the number of canines in the U.S. is around 80 million, which it is, you could talk about what percentage of that market you may be able to penetrate, based upon certain growth targets and depending on your product and how it's addressing this particular vertical within that market. So talking about total addressable markets are one way to handle that. And you could say, if we penetrate 5% or 10%, the numbers look like this. But I do caution companies to be more on the conservative side with that. We've often seen companies have just, thinking that if we put these massive, if we capture X percentage of this market, we can be doing, X number of hundreds of millions or billions in revenue. I mean, be reasonable, be conservative. Investors are smart, and they know when you're being a little bit aggressive with some of the figures, but looking at addressable markets is one way to sort of handle that issue with revenue guidance.
Scott, the next question, does your advice for communicating during a recession extend to a CEO who may feel that their particular industry is currently out of favor?
Definitely. I mean, the market is cyclical, right? We have bull markets, we have bear markets, we have commodity prices going up. So certainly, I think it's, again, as I said, I think it's more important to communicate in bad times and when your industry is out of favor. It's really IR and communications. I mean, it's never easy, but it's so much easier when the stock market's up, when your stock is performing well, when your industry is in favor. And we see this a lot. Biotech stocks are down substantially this year. I think some of the statistics were pretty staggering. I think like 70 or 80%, I think like 60, 70% declines in share prices for a lot of biotech companies. There was a staggering number. I think the majority of biotechs were trading below cash in the past few months. So, biotech comes in and out of favor. Mining's another good example. You have Canadian mining companies that sometimes are in favor, sometimes are not. The industry itself, depending on commodity prices and things like that. So there's certainly a lot of cyclicality. And but again, I think it's important to maintain that message, right? So number one, investors' confidence can be eroded if you change the message, right? So if you change the message in bad times because you think it's the message that investors want to hear, you could be wrong, right? Investors invested in your company because of the original investment thesis. If all of a sudden you're changing this because of difficult market conditions, you may actually damage your credibility with investors, because investors may not want to be part of a company that's having this new turn or looking for new avenues or routes. So I think it's important to maintain that message. Why did you invest in the company in the first place? And telling investors that, look, nothing's changed. We still believe that this product, this resource, this drug, whatever it might be, we still believe, as we did a year ago or 6 months ago or 2 years ago, that there's still incredible opportunity for this. And secondly, as I mentioned during the presentation, it's really important to continue communicating, to be visible. Investors, when they see a company go quiet, it gives them pause, it gives them concern. Now, understandably, companies sometimes pull back in difficult market conditions like we've had in 2022 because they realize that it's difficult to attract new investors and difficult to raise additional capital. And I understand that completely. But it's important, even if the investor isn't investing currently, it's important to plant that seed right now, right? Either if it's an existing investor, they want to know what's happening with the company. If they invested 6 months or a year ago, that nothing's changed, that things are still, on track, things are good. Okay, things are a little tighter than perhaps they were 6 months ago, but investors want that. And then with the existing, with marketing to new investors, they may not they may not make an investment directly. They may not buy the stock in the open market right now. But when the market conditions improve, where are investors going to put their money, right? Investors, go through cycles, right? They pull back and don't deploy a lot of capital in difficult markets. But when the markets improve, they want to deploy capital. Where are they going to deploy capital? They're going to deploy the capital into companies that they met during these difficult conditions because they understand the company's story. They perhaps believe the company is trading at a discount because of the macro environment. And so that's why it's important for companies to maintain the consistent messaging and to maintain visibility with the investment community, even in difficult times.
Thank you, Scott. I believe that was the last question.
Okay, great. Well, I don't know if we want to pause for 10 or 20 seconds to see if any more questions come in from the audience. And if not, then we could wrap it up. But Lisa, let's pause for 10 or 20 seconds and see if anyone else has any questions. So again, to the audience, if anyone would like to ask a question, please put it into the chat box, and we'll pause for 10 or 20 seconds. Lisa, any further questions?
No, I think that that concludes the question and answer session.
Okay, great. Well, thank you everyone again for your time and attention today. Thanks to the OTC Markets Group, to virtualinvestorconferences.com for the opportunity to sponsor and present at today's conference. I really appreciate everyone who dialed in to listen to my presentation, and hopefully all of you found the presentation and the Q&A session informative and educational. And I hope all of you enjoy today's conference, which is sure to be full of a lot of really interesting companies. So enjoy the conference, enjoy the day. Thank you again, and goodbye.